FNB House Price Index's year-on-year growth rate accelerated further in July to 4.6% from 3.1% in the previous month. And joining us in studio to tell us more is John Loos, strategist at FNB Home Loans. Thanks so much, John, for joining us
today.
Alishia. Well, we've been talking about weak credit demand, a worsening unemployment scenario, a slower recovery in growth, and yet we've got this index up year-on-year accelerating. It implies that there's a supply-demand dynamic at play, with demand stronger. Really, is the question being asked?
No, Alishia, I think a lot of this is the lagged impact. From the summer quarters, we had two late 2010 interest rate cuts. There was a little uptick in demand. There was QE2 overseas as well, so the economy did slightly better in the summer quarters. And I think that's still the positive impact of that, the mildly positive impact still coming through into the numbers. So we've had a little uptick in the year-on-year growth figures. But no, I share what you're saying now. I'm very bearish about the world economy, despite the debt agreement that seems to have arisen. Oil prices are very high. There are a lot of negatives out there, and it doesn't look good going forward for the world economy, for the local economy, and therefore I expect this market, I don't expect this to be the start of some sort of sustained rally in house prices.
Of course, also this on a nominal basis, and if you're looking at it in real terms, so adjusted for CPI, we are still looking at a growth rate that remains in negative territory, and that's important to highlight at this stage.
Yes, in June, we've only got the June CPI, and at that stage, given that it was 5% year on year, and 3.1% year-on-year growth in house prices, there was a minus 1.9 odd decline year-on-year in real house prices. So house prices still adjusting downwards in real terms. I think it's important to make that point, because some people think that there hasn't been much of a downward adjustment in house prices following the end of the boom. In real terms, it's been quite significant. Since early 2008, almost 15% down in real terms. So it's been a sizable adjustment to date.
And of course, we use 2008 because 2008 were the boom times, so to speak.
Yeah, the beginning of 2008 was really where the cracks were really seriously starting to show, and that's where the stagnation set in, yes.
So we're still far off from those boom times. I mean, what's the average price of properties transacted in the index? What are we effectively looking at right now?
Well, at the moment, 6 odd % up in nominal terms, yeah. From early 2008. We're at about 815,000 Rand average. But I must just say that the higher-end houses are churn more than lower-end houses more frequently. So there is always in these indexes a bias towards the upper end of the market. 800,000 is not a reflection of the average value of every single house that exists in this country. Your low end, especially your RDP and your affordable segment, don't churn very often, so they don't affect these indexes. So an average has to be treated with caution.
Of course, caution in a scenario where you say you're still pretty cautious on the economic prospects within the country, and that within a global context as well. What's your outlook on the interest rate scenario?
Well, our group's view is that early next year you could see a start of rising interest rates, and that's based on what we've seen recently: oil prices rising, food prices rising quite significantly, and CPI inflation starting to go up. But I think it's a hazardous bet at the moment, and certainly not a foregone conclusion. What's also starting to happen is the weakening economy, the result partly of high oil prices, I believe. Mm-hmm. And if the world economy goes too far down the tubes, and it looks like there's a significant slowdown about to take place, that can dampen inflationary pressures. So I don't think it's a foregone conclusion that we'll have interest rate hiking just yet. Obviously, you've got to make provision for it at some stage in future. Yeah. But I think there's a good chance that it could be postponed by the SARB, given a very weak economic environment. Either way, it's not a good story for property. Whether it's interest rates hurting the property market because they're rising, or whether it's a weakening economy, both have a very significant impact on this market.
How's this scenario impacting who's playing in the market? Are we looking at speculative activity coming to the fore at all, or is it dampened completely? I
don't think so. I think there might be, in the sense, a couple of bold individuals buying up cheap property at repo auctions or so, taking a punt. But by and large, the speculative boom of about 2005-06 thereabout, it took place where capital growth was rampant and interest rates were far lower than that house price growth. So it made sense to borrow, to buy, and in the short term you could make a very quick buck. It made absolute sense. Now, prime rate is at 9% is significantly higher than the 4.6% house price growth. So really, to ride a capital growth trend now would almost be suicidal.
So not a good bet to be waging
it's
right
healthy.
now.
I guess it's a healthier situation nowadays. It's healthy reasons. It's proper reasons for buying. It's not the short-term speculation.
If we look at things comparatively to what's playing out in the global arena, I mean, are we in sync with global trends right now?
Very much so. Our economy is very open, big export and import part of the economy. So we find our economic cycle tracks it and you can see it in the leading indicator, tracks main leading indicators very closely. And so yes, nowadays what we've seen, we had a property price slump around about the time the US did, not quite as extreme as theirs, but it was the same direction. We had that little mini recovery early last year that they had. Their prices slid more recently, so very much in sync, and that's because of the economic drivers. We're a big export economy, and our export demand for our exports gets hampered by global economic trends or boosted. That affects job creation, that affects income growth, and that affects purchasing power in the residential market.
What a domino effect we're looking at. John, we're going to have to leave it there. Thanks so much for your time this afternoon.